Welcome everyone to my first update of 2022. This slide shows the growth of $1 invested in various asset classes over the 3 months ending December 2021. The top performers for this quarter were unhedged international shares and infrastructure, which would have grown to over $1.08. In purple, at the very bottom, is New Zealand shares, where $1 invested would have fallen to 98 cents. A 50-50 mix of shares and property and cash and fixed interest would have grown to a respectable $1.02. A pretty good outcome. This slide shows the growth of $1 invested in those same asset classes over the 2021 calendar year. Interestingly, the top 2 performers from the quarter were also the top 2 performers for the year. $1 invested in unhedged international shares and infrastructure would have grown to $1.28 and $1.27 respectively. The bottom line in bright baby blue is New Zealand fixed interest, where $1 invested at the start of the year would have fallen to 96 cents at the end of the year. Not a great year for fixed interest. Now remember, sometimes to get the zig going up, we have to accept a little bit of the zag going down. That's diversification in action. Third from bottom, in purple, is $1 invested in New Zealand shares, which would have fallen to just under $1 at the end of the year. $1 invested in New Zealand listed property would have grown to around about $1.03. Not a great year for New Zealand assets. A 50-50 mix of shares and property and cash and fixed interest would have grown to over $1.07 over the course of the year. A very respectable outcome. Anyone who has listened to me before will know that I think that 1 year is interesting, but not long enough. I always say we need to look at least 3 years' data. This slide shows the growth of $1 invested from the start of 2019 all the way to the end of 2021 for those same various asset classes. The leader over 3 years is, again, unhedged international shares, where $1 invested would have grown to $1.77. Second, in purple, New Zealand shares would have grown to $1.48. That is despite being the 3rd worst performing asset class last year and negative. A reminder of why we don't react too much to the highs or the lows. Middle of the pack is that 50-50 mix of shares and property and cash and fixed interest, which would have grown to $1.31. Again, a very respectable outcome, given it's a time period that included the COVID crash and the re-emergence of inflation. No, I haven't forgotten what time of year it is, nor am I pining for another visit from Santa, although I do note that he was much more generous to my children than he was to me. Having recently gotten back from holidays and my visit from Santa, I wanted to examine a quirky phenomenon known as the December effect, sometimes called the Santa Claus rally. The December effect is the purported tendency of US shares to increase in value during December. As it happens, that occurred in 2021. What do we do when we have a hypothesis at Cambridge Partners? We test it. This is a chart for the performance of the S&P 500 index, the largest and most quoted US stock index, for the month of December from 1970 to the end of last year. The first thing to note is that these returns are quite volatile. These single month returns range from a lump of coal Christmas, negative 10.23% in December 2002, to a Ferrari Christmas of 20.36% in December 1985. Over this time period, approximately 60% of the Decembers were positive and 40% were negative. The average monthly return for December over this time period was 1.24%. The average of all months over this time period was 1.10%. That difference is not statistically significant. That is, the difference is not material enough to prove a December effect. By the way, even if it was statistically significant, the difference in return is not meaningful enough to exploit after costs. So it looks like the December effect might be debunked, or at least not proven. All is not lost, however. While we cannot prove a December effect, it is true that less bear markets, where a bear market is defined as a decline of 20% or more, have begun in December than any other month in US history. All the way back to 1929, there's only been one bear market that began in December, and that was back in 1961. The lesson? Staying invested is always a good idea, regardless of the month. Thank you for watching. I look forward to updating you throughout 2022.